Have you ever wondered why what is a mortgage is the single most Googled money question in America? Not stocks, not crypto, not even inflation, just mortgage rates. And once you understand why, you'll understand exactly how the entire housing market works. Stick with me till the end, because this could change how you look at buying a home forever. Let's start simple. A mortgage rate is basically the price you pay to borrow money for a house. The lower the rate, the cheaper your monthly payment. The higher the rate, the more expensive that same house becomes, even if the price tag never changes. Here's the part most people miss. A 1% difference in your mortgage rate can change your total payment by tens of thousands of dollars over the life of the loan. That's why everyone is obsessed with timing the market, waiting for rates to drop before they buy. But here's the problem with that strategy. Nobody, not even the experts, can predict exactly when rates will fall. The Federal Reserve moves rates based on inflation, jobs data, and the overall economy, not on your personal home buying timeline. So what do smart buyers actually do? They stop trying to time the rate and start focusing on what they can control: their credit score, their down payment, their debt-to-income ratio. Because here's a secret: your credit score can move your mortgage rate more than almost anything else. A difference of even 50 points can mean a noticeably better or worse rate offer. Let's talk numbers for a second. In 2026, the average 30-year fixed mortgage rate has been hovering in a range that's made a lot of buyers pause. Total household debt in America has crossed $18 trillion, and credit card balances alone are above $1.2 trillion. That means more people than ever are trying to buy a home while also managing high-interest debt, which is exactly why lenders look so closely at your debt-to-income ratio before approving you. There are different types of mortgages too. Fixed-rate loans keep your payment the same for the entire term. Adjustable-rate mortgages usually start lower but can rise later, which adds risk if rates go up. And if rates drop after you buy, refinancing later can lower your payment without moving homes. Now here's something most people don't think about. A mortgage isn't just a loan, it's the biggest financial decision most Americans will ever make. Get the rate right and you save yourself tens of thousands of dollars. Get it wrong, and you pay for it for 30 years. So before you even start house hunting, check your credit report. Pay down high-interest debt first. Compare rates from at least 3 different lenders, because a 0.5% difference between 2 lenders can be worth more than a new couch, a vacation, or a car. And here's the mindset shift smart buyers make. They stop asking when will rates drop, and start asking, how do I qualify for the best rate possible right now with what I have? If this helped you understand mortgage rates a little better, hit subscribe, because here we don't just talk finance, we talk about the future you're building, one smart decision at a time.